Today we are going to talk about the quorum of board meetings of a company. But before we start, we have to know what a quorum is. A quorum is the minimum number of members required to be present for a meeting to be valid and capable of transacting business. Now, generally for companies, the minimum number of directors you need to have for a registered company is not less than 2, and the maximum will depend on what's stated in the Articles of Association. So unless it's a small company, there must be at least 2 directors. Just for clarification, it's possible to have a small private company and a big private company. So the big private company should have at least 2 directors. The small private company can have a single director. When it comes to public companies, they are always big by design and can only get bigger, so the minimum number of directors you need for a public company is not less than 2. One important thing to note here is that if the Articles of Association provides otherwise, then it will override the default provisions in CAMA. Now let's see what CAMA 2020 says about board meetings. This quorum is provided by section 290 of CAMA. So according to subsection 1, the quorum for board meetings will depend on what is provided in the company's articles. But where the Articles of Association is silent, then the quorum would be as follows. If the board of directors has 6 or fewer directors, then the quorum will be 2 directors. So for example, if a company has like 3, 4, 5 or 6 directors, at least 2 of them must be present for the meeting to be valid. However, where there are more than 6 directors, then the quorum is 1/3 of the number of directors. And when the number of directors is not a multiple of 3, then the quorum is 1/3 to the nearest number. That is, rounded to the nearest whole number. For instance, let's imagine there are 7 directors. 1/3 of 7 is approximately 2.33, which rounds to 2 directors. If you're not familiar with how rounding works, I got you. Rounding is a concept in mathematics where you look at the value. If the number after the decimal point is 4 and below, then the number before the decimal point does not change. But if the number after the decimal point is 5 and above, then the number before the decimal point will be rounded up to the nearest whole number. So now let's imagine that there are 7 directors. 1/3 of 7 is approximately 2.33, which rounds to 2 directors. If there are 8 directors, 1/3 of 8 is approximately 2.67, which rounds to 3 directors. If there are 9 directors, 1/3 of 9 is exactly 3 directors. There is no need for rounding here because 9 is a multiple of 3. Now you may be asking, what's the purpose of rounding anyway? It's simply to ensure that the quorum is a whole number, as you can't have a fraction of a person. This isn't 2.5 men. Now what about section 290 sub 2? That's talking about quorum for committee meetings. So where the board of directors appoints a committee, let's say for example an audit committee or remuneration committee, then the board has the authority to set the quorum for that committee's meeting. This means that depending on the committee's size and purpose, the board can specify any numbers to the quorum. But if no quorum is set, then all members of the quorum must attend the meeting, and decisions are then made by majority votes. So let's say for example the audit committee has 5 members. If no quorum is set, all 5 members must attend the meeting, and if decisions are to be made, then they are to be made by simple majority, so at least 3 out of the 5 members must agree. Now that we've talked about the quorum, what would be the consequence if there is failure to have quorum? Well, the simple consequence is that the board will not be able to act, and any transaction of business or resolution will be invalid. Now, in the case where the board is not able to act, the general meeting may act in place of the board. And where a committee created by the board is unable to act because a quorum cannot be formed, then the board of directors may act in place of the committee. Now, I don't know if you've noticed, but CAMA only addresses the quorum for these boardroom meetings. It doesn't give specifics of how many members are actually supposed to be there. And of course, quorum is needed for a boardroom meeting to be valid. But then CAMA does not specify the number of members that are supposed to be in that board meeting. How many members of the board are there supposed to be? Are they supposed to be 5? Are they supposed to be 15? Are they supposed to be 7? Well, CAMA is silent about this, and for good reason. As a company, you are supposed to lay out your own structure for board meetings, because these board meetings can vary in size, depending on the type of company. Now, this is where the codes of corporate governance come in. They give specifics as to the composition of the board. So for example, Code of Corporate Governance for Public Companies 2011, brought to you by SEC, Securities and Exchange Commission, said that the members of the board meeting shall not be less than 5 persons. It does not give a maximum. When you look at the Code of Corporate Governance for Banks, Discount Houses, and Guidelines for Whistleblowing in Nigerian Banking Industry 2014, brought to you by CBN, Central Bank of Nigeria, it states that the board shall be comprised of not less than 5 directors and not more than 20 directors. But if you look at the 2023 circular by the Central Bank of Nigeria, which is the corporate governance guidelines for commercial, merchant, non-interest, and payment service banks in Nigeria, The composition has been updated, and so when it has to do with board of directors of commercial, merchants, and non-interest banks, the minimum number of members shall be 7 and the maximum number of members shall be 15. For payment service banks, the minimum number of members shall be 7 and the maximum number of members shall be 13. Now, it's important to note that these codes are not intended as a rigid set of rules, but more like guidelines for corporate governance. With that being said, it's usually advisable for companies to comply with these codes, as such compliance can be stated in the company's annual reports. Just so you're not confused, commercial banks are the banks you're familiar with, like Access Bank, Zenith Bank, First Bank. They offer current, savings and fixed deposit accounts, provide loans, overdrafts, trade finances, all that stuff. Just your normal banks. Merchants banks are what I'd like to call wholesale banks. These merchants banks primarily cater to corporate clients, high net worth individuals, and institutions. They do not typically serve retail customers like you and me. As for payment service banks, these are specialized banks licensed by the CBN to provide financial services, primarily through digital and mobile platforms. So they operate mainly through mobile apps, POS terminals, and agent networks, and their target is for low-income and rural customers. Examples of a payment service bank are Smart Cash and Momo. And finally, non-interest banks. So these are banks that operate either under Islamic banking principles or other non-interest models. So they avoid interests and focus on profit sharing. Examples of non-interest banks are Jaiz Bank and Taj Bank. Thank you very much for watching my video. If you like what you just watched now, please like, subscribe, and share with your friends. Also, please feel free to hit the notification bell so that you get updates when my videos come out. Engaging with the content actually helps the algorithm see my videos, so I get to share it with more people. Don't worry, we'll be getting more content like this. Have a great day.